As before, the webinar will be led by Jerome Stern, Managing Partner, and our CIO, Chris Rosbach. They'll be joined today by Giles Tulloch, who leads on our technology investments. Giles has been at the firm since 2014 and has helped us to choose many successful stocks in the technology space. In addition to our performance and the composition of the portfolio, we'll be talking briefly about 5 other things today: multiple compression in equities, inflation, the global supply chain, the exposure of our stocks to Russia and Ukraine, which you'll see is low, and Giles will be talking about NVIDIA, which we bought in the first quarter. NVIDIA has enormous long-term growth potential with its GPU accelerator chips. We already have some good questions. Please do send more if you wish. I will now hand over to Jerome.
Thank you, Sandy. Good afternoon to everyone who has joined us. Thank you for taking the time. We're pleased with the development of our World Star strategy and the resilience of the underlying companies. Our business is growing well, with AUM now over $1.1 billion, supported by strong performance and inflows. About 25% of the assets we manage are owned by my family and the partners, and the balance by other families, charities, trustees, wealth managers, and institutions. The World Star strategy is now over 9 years old and has delivered results well ahead of our target return of 8 to 10% per annum or more over the long term. It invests in a concentrated group of 20 to 30 high quality, sustainable, global and large and mega cap stocks with enduring competitive advantages and a long runway of growth, selected through our intensive in-house fundamental research. As always, quality is the defining condition for a stock to be selected, followed by value. ESG is fully integrated into our investment philosophy, and we strongly believe in the correlation between ESG, sustainability, and investment returns. The strategy has been managed by the same team since 2014 and is available through separate managed accounts as well as through our UCITS fund, which just celebrated its third anniversary. Investors can invest alongside my family in a strategy that has successfully generated strong returns over close to 70 years. Despite the current market turbulence, I'm pleased to report the continued resilience of our World Stars portfolio and its performance. As at the 22nd of April, our fund was down 14% in US dollars, slightly below the MSCI World Index during this volatile period that encompassed the Russia-Ukraine conflict, alongside the currently unfolding inflation spike and the expected strong central bank response. Whilst our fund ended the quarter down only 8.2%, on a 5-year view, the World Stars fund has delivered 12% CAGR in US dollars, ahead of the MSCI World Index. As long-term investors, we see the current volatility as an opportunity, as valuations of our companies have compressed significantly. And yet, most of them continue to report robust trading conditions. Despite the current market volatility, our conviction only grows that quality is the key driver for long-term sustainable performance with solid downside protection. Long-term investors, such as ourselves, contemplate these periods as buying opportunities, and we expect buyers will continue to step in as prices decline. We remain optimistic about the global recovery over the next 2 to 3 years and confident in the ability of our focused portfolio to continue to deliver significant value over time. I will now hand over to Chris.
Great, thank you very much, Jerome, and welcome to everybody who's joining us. Thank you also from me for taking the time. I wanted to start out by just recalling for those of you who are joining us for the first time, how exactly we define quality and value, which is at the core of our investment approach, as Jerome just said. And so want to go through and take us through the 4 criteria. Quality for us is a gating condition. It is what we're looking for in the companies that we invest in. And if a company doesn't have the quality we're looking for, it can be as cheap as it wants. We won't invest. Value for us is being able to buy those companies at prices that allow us to generate returns of 8 to 10% or more, in some cases much more, over the long term. And so the key criteria we're looking for are a strong and sustainable competitive position, sustainable always also in the sense of ESG, because as Jerome said, we strongly believe that only companies that are sustainable in how they act and how they address their suppliers, their customers, and their other stakeholders can have sustainable competitive advantage and can generate sustainable returns over time. They need to be in good and growing industries, good in the sense that they're consolidated so the participants can make money, and growing because there should be some reason why companies should do better going forward than they do now. And that can be because of overall economic growth, can be because of demographics, it can be because of other changes in preferences or other considerations, or because of technology and innovation. We then look for managements with a record of value creation. We're active investors who will represent our interests, but we're not activists. So we look to invest with management teams that have delivered value over time. And finally, the financial strength to weather any kind of adversity, which is critical in difficult periods like we've had during the pandemic, and we're facing today with the adversity of the Russia-Ukraine conflict, but also the turning point that we have in the global economy and the change in central bank stances in response to the inflation that we're seeing and that we're going to talk about. So it's the financial strength that gives companies the ability to invest and to become stronger, to potentially acquire companies that help them to increase their competitive position. And it's one of the key things that we look for in terms of the quality that we want. So these are the criteria that we apply, and these are enduring conditions. We believe that it's, as you and those of you who've joined us know this, we believe that we're in a world where it's about OPEX, not CAPEX, where it's about intellectual capital, not physical capital, and where it's about the cash flows that companies generate and their capital allocation, and not so much about the returns that they may generate over some tangible or intangible capital that they've either sunk or that they've crystallized as a result of some kind of transaction. So it's that forward-looking definition of quality that allows us to find companies that will do well over the next 5, 10, or even 25 years, the long-term holding period that we're looking for. The value we're looking for is more of a spot measure. The quality is enduring, the value is the opportunity when it comes, and that's why we think that volatility, like we have from time to time, but also sector rotation, overreaction of markets to interest rates, like we're having right now, and other type of short-term measures are opportunities for us as long-term investors, keeping a strong perspective on the fundamentals of the companies that we invest in. And that's because we think, and we will get to the outlook, we're basically in an environment where we have a strong economic recovery that is impacted by the significant headwinds that we're facing, but that is at the core of what is driving the economy, the companies that we invest in, their results, but of course also the wage inflation, the commodity price inflation because of bottlenecks, and the central bank response that comes with that. So if we turn to the next page, I want us to look at the portfolio composition. You can see that the portfolio continues to be entirely invested in companies listed in the US and in Europe. So the largest, most liquid markets with the greatest alignment between shareholders, companies, their managements, their boards, and their other stakeholders. And that reflects a deep conservatism on our part in terms of the quality we look for, because it's those companies that are also most accountable. It has kept us away from investing in places and companies where there is greater volatility and uncertainty. And I think over the period since 2012 that we've been managing the portfolio, that has held us in good stead. Still, the portfolio is entirely global. You can see it's about 40% exposed in terms of underlying sales to the US, about 20% to Europe, and the rest to the rest of the world. Most of that is Asia, because we add up those numbers ourselves, because these are not numbers that are readily available in a way that we think makes sense. So it has completely global exposure in terms of where the companies we invest in do business. It's very diversified in terms of the sector allocation that you see, but in terms of what we actually invest in, that's our own classification. The pie chart that you see on the upper right-hand side, and there you can see it's the areas and the types of companies we like. It's about digital transformation. It's about consumer companies, either in consumer staples or discretionary. It's about healthcare and life sciences companies that are benefiting from the recovery in spending and the opening up of hospitals. And it's about industrials and infrastructure companies that are a part of what we think is an investment boom that we're having, and that will help to unbottleneck large parts of the global economy, but they also will be shovel providers to net zero, which we think is going to be an enormous driver, as we outlined in the last webinar, where we quantified that it's a $1.5 trillion investment need in order to achieve the climate goals that we have, and that is going to have to be fulfilled by companies, including the ones that we've been invested in. So if we turn to the next page, we wanted to show you what the performance has looked like over the last year, and what it's been driven by. Because one of the key things that takes place, and it's what I alluded to in terms of the sector rotation, is as markets adjust to the transition that we're into, this idea that with the strong recovery from the pandemic and the bottlenecks that have been exacerbated by the lack of investment, but also by the disruption from the pandemic, which continues in China with the lockdown measures that they're taking, there's been significant rotation. And what you can see over the last year, that the returns have been driven by companies that are related to that recovery. For 2020, it was very much the beneficiaries of the pandemic, the digital companies and others that had revenue increases as a result of this. But what you can see here is that the best performer is in industrials and infrastructure. That's the dark blue bar you see there. You see that there's companies in healthcare and life sciences that are benefiting, as I said, from the fact that hospitals are now reopening and elective surgeries are coming back, although there's a tremendous bottleneck, which is an opportunity for the companies that we're invested in. And then consumer companies, but of the sort that are more about consumer discretionary demand, the luxury goods companies, but also companies like Essilor, the world's leader in glasses and sunglasses and lenses, which is a demand that is coming back very strongly. As it turns out that people do want to consume, they do want to travel, they do want to go out, and some of these consumption patterns are resuming very strongly. I think it's just as interesting to look at the stocks that have not performed, and those are in particular the ones in digital transformation. Those are the light blue bars that you see there. And so it's really striking to see that despite the fact that they've performed exceptionally well, that they have continued to grow, as we've seen even with the most recent numbers, and Charles will talk about Facebook as part of our a more specific update on some of these companies. They have derated very substantially, and they're among the very cheapest stocks in our portfolio. So we are focused on the fundamentals. In 2020, we were buying companies that fell into our valuation zone because of what was going on, that were more related to cyclical demand and were hit by the concerns at the time. And last year we bought Salesforce. This year we bought NVIDIA, which Charles is going to talk about, which are technology companies that have tremendous prospects, but that have been sold off very significantly by markets because of these short-term concerns. We then wanted to discuss with you an update on the page about what we mean by quality and how it compares to the more traditional definitions of growth and value. And so we've put together a chart here that we've showed before, which is about the EPS growth of the companies that we've been invested in, and the 12-month forward price to earnings ratio. And you can see that the growth has moderated a bit. The price to earnings ratio has come back. And so now the big blue dot, which is the WorldStar's portfolio, is now smack in the middle. We think that it's very sensible EPS growth right now. The comparisons are difficult. It's one of the elements that makes this year a transition year. We've had a very weak 2020. We had a very strong 2021. So we're having a mixed 2022 because of these difficult comparisons. And that's something that we just have to live with because it's in the nature of the economy. It's something that markets don't like particularly, but something that we can look through and again, use as an opportunity if we understand what's driving. And so you can see we've got some stocks that have higher growth. We have some stocks that are at lower valuations, and Facebook is one of those. But despite the growth that it's delivering, but what you can see is that there's a very clear cluster that is around the middle, that is around, in particular, companies that are valued around 20 to 25 times price to earnings, regardless of the growth, whether it's very rapid or whether it's very sustained. And I think that that reflects the balance that we have in the portfolio and what we mean by the quality and value investments that we have. We then turn to the next page. This is an update on what's been happening in this growth versus value equation. We've now looked at the MSCI World. We previously showed you the S&P 500. The numbers look very, very similar. But what you can see is that over the last 5 years, it's been growth that has been outperforming very substantially, and it's been coming back. But it's driven, we think, very significantly by the underlying results of the companies, and only to a much lesser degree by the multiple expansion and by the broader concerns that have now become such headline grabbers. The really interesting thing is the chart on the right, and that's really where the update takes place, where you can see we're now into the second period in which there's a significant rotation. The first one took place from the end of 2020, when it became clear that the vaccines were working and people were starting to look forward to recovery. And you could see that at that point, the value stocks, the ones that have more cyclical exposure, that are cheaper, often for a reason, because something's gone on, or they have weaker balance sheets, or there's some other reason why they did not fare so well over time and during the height of the pandemic or the crisis, whichever it was, they would outperform, and the more stable companies performed less well. You can see that in 2021, that lasted until roughly the end of the summer. And that's two things. We think, one, it's the very strong underlying results that the companies continue to deliver. But secondly, it's the Omicron and other variants and this concern that we had that the pandemic was going to postpone the very rapid recovery and the very strong and, in hindsight, exaggerated expectations about what interest rates will do. And we think we're frankly in a very similar period for different reasons. But you can see they correlated, and since the beginning of this year, roughly, the scissor has opened again. So the value stocks have done better. The growth stocks in particular have sold off, and you can see it's actually interesting. Last year, what it was an appreciation and a lag. This year, it's actually more of a flatlining and a sell-off. We're thinking that it's pricing in things that are not likely to take place because while there is a strong recovery and there's inflation and rates are rising, this is benefiting companies, and in particular, it's benefiting the types of companies that we're invested in. And so the fact that their stock prices have sold off and the results have continued to increase means that they're cheaper than ever. We think, as we said, that volatility is an opportunity, but we in particular think that rotation and short-term reactions like this are opportunities. That was the case in March of last year. We think it's very much a case again this year. So one of the ways, if we turn to the next page, that illustrates that, and this is really just a very short illustration of something that I think most of us are aware of. This is just looking at the 10-year MSCI World forward price to earnings ratio, and you can see that it peaked at 25.4 times in 2020 towards the end of the year, beginning of 2021. But you can see how very strongly it's derated. It's now in line with long-term averages, while we are in the middle of a recovery, and while the prospects for the companies are strong. So whatever it is that we thought before, and clearly our portfolio has pulled back in line with markets and slightly more, whatever we think I think is now, even from this very simplistic market perspective, already very much in the process of being priced in particular, if you believe, as we do, that we're looking at a recovery and not at the early stages of one, and not some kind of late stage issue. If we then turn to the next page, it's another perspective that we want to offer about the portfolio. This is an analysis that we have on an ongoing basis, but we haven't shared in this format, and that is to compare the way the World Stars Global Equity Portfolio compares to the MSCI World and to the MSCI World Quality Index, which is a subset of companies that are considered quality, but in a more conventional sense. Again, our definition of quality is forward-looking, and based on the criteria that we have, the traditional definition of quality, including franchise and brands and similar types of considerations, is much more around historical backward-looking measures of consistency, of persistence, of balance sheet strength, and those kinds of things. So it tends to be a slightly different set of companies, but it's important to understand what that difference is when you look at what we mean by quality and value versus what is contained in these other approaches. And so what you can see here is that our companies have very significantly higher revenue growth that they are that we expect them to deliver. They have significantly compared to the overall market, and very significantly compared to the overall market, significantly compared to the quality index, higher margins. So they're more profitable, despite or because of the fact that they have higher growth. This is exactly what we're looking for. They have a return on equity that is much higher than the broader market, and that is a bit lower, but very much in line with the returns that are generated by those quality companies. And they are trading at somewhat higher price to earnings ratios is the easiest comparison, because of this much higher, this better profile that they have. And so I think what we're trying to highlight here with the actual numbers of the underlying portfolio is that we think that the price we're paying for the quality is very much worth it, because it is delivering higher growth, higher profitability, comparable returns, and therefore much higher cash flows and prospects, therefore for value creation, because it's ultimately based on the cash flows that companies generate that they're valued. So those are the perspectives that we wanted to offer in terms of where the portfolio is and what the spot measure of it is, including the pullback that we've had this year. I then wanted to focus a bit on this perspective of where we are in terms of the overall outlook and the drivers that we see going forward. I've said again that the reason why we're where we are is because of the strong recovery that we have in the global economy. I think it was held back by the pandemic. It is now all the stronger as we've largely overcome the pandemic, understanding, of course, the issues in China and the potential risks that are still out there. But the shortages that we're seeing have to do with a very significant lack of investment that we've had over the last 20 years plus. We have not invested in a productive capacity. We have not invested in commodities for a number of reasons. And so therefore, it is really not surprising that we have those bottlenecks and that they're being exacerbated by the effects of the pandemic. And the terrible conflict between Russia and Ukraine has exacerbated that even more, in particular, in terms of the commodities. It may be one of the reasons why Putin decided to do what he did, because he thought he was at a point of maximum leverage in terms of the commodity price commodity underinvestment that we've had. But like with everything else, there will be a supply side response. There will be a realignment, and there will be therefore an increase in supply and abatement of some of these issues. It will take time. We will have to get through it, but like in the pandemic, where I think the global community, global business, governments, research organizations, healthcare, and life sciences companies came together to provide a solution in the form of the vaccines. I think the same is going to take place in terms of the commodities, both in terms of supply and realignment, that will mean that this moment of leverage will pass very quickly. And I think that we have to be very careful not to make investment decisions that are based on the kind of headline inflation numbers that we've seen. So just to summarize, we think that globalization has been a major driver since the 1990s. It has been a realignment of the global economy. It has meant that supply has been delocalized. It means that we've been able to move to just-in-time production almost regardless of how far or from where the goods come that are part of that supply chain. And of course, it's created enormous markets, most especially in China and in Southeast Asia, but delivered tremendous value, prosperity, poverty reduction, and opportunity for many companies. There have been significant costs in a number of ways, in particular in terms of the environment. It's been deflationary and it's ongoing. In terms of digitalization, that has been really a driver. We peg it to the 2000s. It's come in different phases. First of all, in terms of the ERPs that have helped companies to be more efficient. It's one of the reasons why we think margins are sustainable. A second phase, which is the internet, broadly speaking, whether that's search and e-commerce, moving into the cloud and moving to much greater scale in terms of computing that have really transformed how we do business, how we communicate and interact. It includes the devices that we've had. And then the third phase, which is blockchain, that we're just at the beginning, really, in terms of realizing what is going on. And we could frankly add to this the metaverse, which I think is the second big driver in addition to blockchain that will change things. Are we a quarter of the way through? Who knows? But it's a very significant driver going forward for our societies, but also for the companies, and it reflects in the decisions that we're making in terms of our investments. But then the third point, and that's what I've been talking about, is the capital investment, this underinvestment, and we think we're just at the beginning of catching up on that. It's addressing global challenges, it's debottlenecking production capacity, it's making it more efficient and productive, and it's also going to make it more sustainable because much of it is about renewable energy and about reducing the carbon and other resource footprint that we need in order to deliver the development that we need. So we think there are tremendous opportunities. We highlighted some of those last webinar, but we believe in them just as strongly. Again, they're impacted in the short term by the Russia-Ukraine conflict, and they are leading, this growth is leading to inflation, which is leading to interest rate rises, which is the concern that we're facing. But we think that it's investing in the kinds of companies we do that will allow us to prevail. But I'm now going to turn over to Giles, who is a partner and a senior analyst and who's responsible for our technology investments. And he's going to talk to us about our investment in NVIDIA, the company that we added this year. And he's also going to talk to us about Meta, which is very topical, possibly the cheapest company in our portfolio, 20% less cheap this morning after the results that it delivered last night. But Giles will share our perspective on that as well. So with that, Giles.
Great. Thanks a lot, Chris, for that introduction there. Yes, as you mentioned, we've seen a lot of the share prices of the tech sector decline recently. Amongst them is NVIDIA, and we felt it's a great opportunity to buy shares at these lower levels. When we think about all the future technology advancements, be it the metaverse, quantum compute, crypto, self-driving cars, 5G, artificial intelligence, machine learning, cloud computing, high-performance compute, and data analytics, what these all have in common is that they rely upon NVIDIA's products and services. NVIDIA is a semiconductor company. Its focus is on accelerated computing. It began with the GPU, that's a graphical processing unit, and its first main use was in PC gaming. Essentially, this allows for parallel processing of tasks, which is ideal for graphics rather than sequencing. This parallel processing technology and architecture has now evolved into becoming the foundation for modern artificial intelligence processing and development. As it's grown, NVIDIA has also become a platform company. So this means, whilst it still sells chips and systems, it also sells software as well that best enhances its technology. This means that NVIDIA can now address over 1 trillion market opportunity. One underestimated part of the competitive advantage for NVIDIA is that they have over 3 million developers on its platform. All these developers have spent a long time learning the NVIDIA CUDA stack and language, and so it become very time consuming and difficult for them to use both a different hardware and software platform. NVIDIA also spends a significant amount on its R&D to ensure its products are multiples ahead of the competition in terms of performance. NVIDIA also has a very large set of high growth markets that it sells into, and I'll talk briefly to them. The first market is the PC gaming, and whilst it's had very solid growth, we think there's much more growth ahead, especially given the secular trends towards gaming as a leisure activity, the rise of esports and streamers, as well as cloud gaming, where NVIDIA allows gamers to rent hardware in the cloud rather than purchasing the graphics cards. There's still also many gamers that haven't yet upgraded to the latest graphics cards, and with all the newest games incorporating technology, such as ray tracing, into the game, these are all best enjoyed using NVIDIA's cards and capabilities. The data center business has been growing very rapidly, at over 60%, and it's almost the largest division now at NVIDIA. This really is the sweet spot of all these major technology trends that I spoke about earlier, especially high performance compute. As we've seen in the earnings this week, the cloud computing giants continue to build out their infrastructure, and enterprises continue to shift more workloads into the cloud. NVIDIA are going to be at the heart of this digital transformation. And then there are two smaller businesses, but we think have got huge opportunity for NVIDIA. Firstly, professional visualization has picked up with the increase in remote working, as we're all using these sorts of platforms like Zoom, but also the metaverse that has recently sparked interest, especially with Meta's name change. Professional visualization can also be used in the enterprise, for example, in a 3D simulation that draws upon the expertise it has in PC gaming. Lastly, the automotive business, whilst it's very small right now, we think it's going to be huge over the next decade as auto production begins. NVIDIA signed landmark deals with Mercedes-Benz and Jaguar Land Rover, as well as many more large auto manufacturers. The car is essentially going to become a computer on wheels, and with all these self-driving capabilities, trying to manage all these different sensors and controls in real time, it will require high-performance chips and software systems. As such, with large, attractive and growing end markets, a very strong competitive position, and NVIDIA shares declining by a third from its highs, we felt the valuation below 30 times PE is very, very attractive. And the opportunity to buy shares in a company that will essentially determine the future of technology over the next decade, we thought was a too good opportunity to pass up. And then with that, I'd also wanted to talk a bit about Meta, because that's probably been the worst performer in the portfolio. I want to sort of reiterate our confidence in the business, and we think right now is a great opportunity to own shares at these levels. As you can see, the Meta share price has fallen quite dramatically, by about 45%, and it trades on a very undemanding 12 times PE. So as Chris mentioned, whilst the company did report its results last night, the shares are up sort of 15 to 20% after hours, it has recovered some of this decline, but we still think it's a super opportunity here. If we sort of think about why the shares have fallen, I think you can sort of summarize it into four main reasons. Firstly, Apple's IDFA changes that impacted the whole of the digital advertising sector. It hinders the ability to target and measure the effectiveness of adverts. But yet the Meta management team have invested a lot to solve this problem, and starting with artificial intelligence to provide better content recommendations, we've got a lot of confidence that the Meta management team will be able to continue to improve the measurement and targeting capabilities. Secondly, we've seen competition from the likes of TikTok, but I think it's important to note competition is healthy. It's good for the consumer and also for innovation. Meta brought out new features themselves, such as Reels, and they told us last night that that now accounts for 20% of time spent on Instagram. Thirdly, there's the constant loom of regulation. On one end, it will be the unwinding of the purchase of Instagram and WhatsApp, and on the other side, initiatives like GDPR and the Digital Services Act. We think regulation is necessary, but we don't think the Meta will be forced to unwind their transactions. And the regulations themselves probably won't end up as harmful as suggested in the media. and we think that Meta will be able to find workarounds and solutions. Lastly, Meta are lapping a very huge 2021 as we came out of the pandemic and we saw a boom in e-commerce and the associated advertising. We think that this will of course normalize, but let's not get caught up in these short-term year-over-year comparisons. But if we take a sort of a longer lens and look at the 3-year CAGR, the company is still growing at over 20%. We've got a lot of confidence in the management team. They've navigated their way through past change before, for example, the shift from desktop to mobile, and they've also been able to introduce new formats like stories. Instagram has created an entire e-commerce ecosystem, and they've got lots of ways they're going to monetize this over the next few years. And also, it's important not to forget the core advertising business on Facebook and Instagram still delivers best-in-class returns on investments for advertisers. Meta also innovating. They've got new formats, like I mentioned, stories and reels. These all help to improve the engagement on the app, and it helps to diversify the revenues as well, away from the core newsfeed. And I think, most importantly, Meta, as signaled by its name change, is working on the metaverse opportunity, which can be valued in the trillions. One important feature of the metaverse is that it removes the reliance on the smartphone and hardware from other players. Meta can create its own ecosystem of hardware and software to deliver the best experience. As such, where the shares are right now, I think it more than accounts for all these concerns. It doesn't reflect the strong position the company holds in its existing core advertising business, and it doesn't ascribe any value to the long-term opportunity ahead. We remain very confident in Meta here. And with that, I'll pass it back to you, Chris. Thank you.
Thank you very much, Giles. And I think there's a lot more to say, but we can answer questions in the Q&A when we get to it. But I want to then shift the conversation back to the outlook and to some of the things that are going to impact the portfolio in particular this year and going forward. So the first one is to offer our perspective on the Russia-Ukraine conflict. The first thing that we've done is we've laid out for you here the percentage of revenues that the companies that we invest in have in terms of Russia and Ukraine. And you can see that it's low in aggregate. So if you look at the digital transformation, healthcare and life sciences companies, it's basically below 1%. If you look at the consumer and industrial companies, it's higher. These are averages. And so in some cases, it can be as high as 4% in the case of some of the consumer companies that are involved there. But we think that these are, while they're substantial businesses, given the scale of the companies, they're not large and not meaningful in terms of the overall businesses and therefore the prospects of these companies. I think it's helpful to put that into perspective. I do think it's important to note that companies like Nestle and LVMH employ thousands of people in the regions, thousands of people in Russia, that in the case of Nestle are still providing essential products for the population, that they are supporting in the hope that there's a resolution to the conflict that allows them to resume doing business there. But very importantly, and this is something that we feel very strongly about and that is not highlighted very much, providing services for the population in Ukraine and for the displaced refugee populations, in particular in Poland and Romania. It's one of the functions of these companies like Nestle, having the scale that they do, that they can be operational. The latest number that we had was that Nestle was operating at 40% of its capacity in terms of providing food in Ukraine itself. And it's providing tens and hundreds of thousands of tons of food to the populations there, as well as to the refugees. So in the same way that infant nutrition is essential everywhere, infant nutrition in Ukraine and for the populations that are displaced is critical. And we think it is an important part of sustainability that the companies are making a commitment to provide that. The other point is, what is the impact going to be from our investment perspective? Our hope, of course, is that it gets resolved with the least possible human cost. But as I said at the beginning, we think that it is exacerbating some of the issues that we have that have been facing the recovery and the bottlenecks. And in a similar way as the pandemic has impacted globalization by making clear how fragile some of these supply chains are, and is going to lead to a relocalization and a realignment of supply chains. We think the Russia-Ukraine conflict is going to lead to a realignment of commodity supply chains. It simply is mattering more than it did in the past where you buy your commodities. The overall demand for oil and gas, for fertilizer or for grain is not going to go down, it's going to go up until there are renewables, in particular. But where people buy will change. That will cause disruption. That will be somewhat inflationary because there will be costs involved with it. But it will be a realignment, and there will be a supply response that will take place to support that. So we think it's a transition issue. The faster the conflict gets resolved, the less significant it will be. But as we shift to the perspective on inflation, we very, very much have to keep that in line. And so the final point that we want to make is around inflation. We're at a very important point around that. But one of the things that strikes us, again, it's because of the positive economic outlook. It's because of these bottlenecks. We were worried about deflation. Now we're worried about inflation. We think that is a much higher class problem to have. We think there's no indication whatsoever that central banks have lost control. On the contrary, they are acting forcefully. One of the things that I think we really have to remind ourselves as we head into this inflation period is that there's a distinction between headline and core inflation. And for commodity price inflation to abate, you just need oil to stay at 100 and not go up anymore. And you're at 0, you can have it go to 80 and it's minus 20. So again, I think we have to be very cautious about these strong headline numbers and not overreacting. The situation is different in the US versus Europe, where here in Europe we have an energy problem that is exacerbated by the issue with these gas supply issues that we're having. The US Fed's beige book came out and so shows very substantial growth, which I think justifies the moves that they're making. But as we look into the second half of the year, as some of this headline inflation will abate, as there will be a supply response, we would not be surprised at all to see a moderation of these numbers, and then also a moderation of the Fed's policy, because there's no indication that they will be anything other than data-driven. And the idea that after a period of largely successful intervention and cautious intervention, whether they could have acted a bit faster than they have now, I think is a matter of discussion. But after a period of broad policy success, they should make some catastrophic error that would turn the global economy or the US economy into recession. Given the strong underlying growth that we're seeing, we think is highly unlikely. And therefore, we also think making investment decisions on the expectation that either this high headline inflation will prevail or that there will be a recession, we think is likely to be wrong. So to us, it means that we believe in investing in the types of businesses that we do that are able to withstand that inflation. You can either have assets with scarcity or you can have productive assets. You can invest in them at different times. We prefer to invest in the biggest and best global companies that have the quality, the prospects to grow, the scale to offset the inflation, the pricing power to increase prices, as the companies that we're investing in are doing, and we're seeing that with the results, the balance sheet strength to operate through this, and also to weather the volatility that their share prices will have as markets adjust and as results are choppy because of difficult comparisons. So we continue to be optimistic about the prospects of the companies. We think this year will be somewhat more volatile than previous ones because of this transition period. But we very strongly believe that as we go ahead and as we look forward into the second half of this year into next year, we're going to find that hopefully the conflict gets resolved, but that the underlying outlook for global growth is solid, that inflation will be a persistent presence, what will not be as strong in a headline basis as it's been, that therefore the attention can shift back to fundamentals, not just in terms of what companies do, but also in terms of what investors appreciate.